Welcome back to the deep dive. We're the place where we grab your curiosity and really try to turn it into knowledge you can actually use. Today, we're jumping into something that honestly can simplify one of the most, well, overwhelming parts of running a business or making big decisions. It's all about the numbers. I mean, have you ever just stared at a spreadsheet, right? Trying to figure out if, I don't know, a new project's worth the investment, or maybe if you should cut a product line that looks like it's losing money, and you just feel completely lost in this, like, sea of costs and revenues. Yeah, you're definitely not alone there. It's so easy to get bogged down by every single dollar figure. But what if I told you that a lot of those numbers, maybe even most of them, might actually be completely irrelevant to the specific choice you need to make right now?
That feeling, that being lost in the data, that's exactly what we want to tackle today. We're essentially pulling out a really powerful flashlight for that often, let's face it, dark room of financial information. It's a framework known as marginal analysis. And our mission, really, in this deep dive is to give you a vital lens. Maybe think of it like financial night vision goggles, something that helps you cut straight through all that noise, all the confusing figures, and focus intensely on what truly changes as a direct result of your decision. It's all about stripping away everything that doesn't actually impact the choice you're making. And by doing that well, those crucial business choices become much, much clearer and hopefully more profitable too.
Okay, night vision goggles for finance. I like that. So let's get right into it. What exactly is marginal analysis fundamentally? Why does it give us this superpower?
Yeah, fundamentally, at its very core, marginal analysis is an operational decision method. And what it does is help businesses isolate and then examine only the revenues and costs that are directly affected by one specific choice. And it's incredibly versatile. It's really more of a mental framework,
Yeah.
something you can apply across a huge range of business dilemmas you see used everywhere. Deciding whether to launch a brand new product or maybe just tweaking the output levels of ones you already have. Navigating those critical one-time decisions, like accepting a special order that comes in at a different price than usual. That's a big one.
Okay.
It's also invaluable for make or buy decisions. Should we produce this component ourselves, or is it cheaper to outsource it? And it even guides those really big, complex strategic choices like, should we process a product further, add more value, or just sell it as it is? And yes, even the really tough calls like adding or maybe more painfully, dropping an entire business segment.
Wow. Okay, so it covers a lot of ground. But the underlying idea, like you said, is always the same: focus on what changes. But here's where I think people often get tripped up. When you're looking at all those numbers on the page, how do you actually tell the difference between what truly changes because of your decision and what just, well, looks like it changes or feels important? Is there a common trap people fall into?
That really is the million-dollar question, isn't it? And the principle is actually simpler than you might think, but putting it into practice can feel a bit counterintuitive sometimes. When we talk about relevant revenues and relevant costs, we mean only those revenues and costs that actually change as a direct result of picking one alternative over another. That's the key. So if a revenue stream or a cost stays exactly the same, no matter which option you choose, like whether you launch that new product or you don't, whether you accept that special order or you don't, then it's just irrelevant for that specific decision anyway. It's kind of like, imagine the background hum in a factory. It's there, it's a real sound, but it doesn't help you decide whether to turn on machine A or machine B if the hum stays the same either way. The really common pitfall is including everything just because it's listed as a cost instead of rigorously asking, okay, but will this specific number be different if I choose option A versus option B? Now, here's a really important clarification, and honestly, this is often an aha moment for a lot of people.
Yeah.
There's a common misconception that variable costs are always relevant and fixed costs are always irrelevant. And that's not quite right. It's a bit more nuanced.
Ah, okay. I could see how people might think that. Variable means it changes, fixed means it doesn't, right?
Exactly. That's the intuition. And while variable costs often change directly with production volume, which makes them highly likely to be relevant, they aren't always relevant to a specific decision. For example, think about electricity. Its usually variable cost goes up when you produce more. But if you're choosing between two machines, and both machines use the exact same amount of electricity to produce the same output, then for that specific decision of which machine to use, the electricity cost is actually irrelevant because it doesn't change between your options.
Interesting. Okay, so even variable costs can sometimes be noise?
Precisely. And conversely, fixed costs, which typically stay static regardless of how much you produce, think rent, salaries, they can absolutely be relevant if a decision causes them to change. Imagine you're deciding whether to significantly expand your production, a
Right.
really big expansion. And if that expansion means you absolutely have to rent a much larger factory, well, that new, higher fixed cost for the bigger factory space becomes highly relevant to your expansion decision, even though factory rent is normally a fixed cost.
Right, because the decision caused the fixed cost to change.
You got it. It's all about whether the cost is truly impacted by the choice you're making right now. So, what's consistent among relevant costs is they usually share this characteristic of being specifically traceable to the cost objects that might change depending on which alternative you select. Ultimately, the real acid test for a cost's relevance is its potential to actually affect the decision you're about to make. If it has zero bearing on which path you choose, if the numbers don't actually move based on your action, then it's just noise. You should actively ignore it for that decision.
That distinction, just focusing ruthlessly on what changes versus what doesn't, that feels incredibly powerful. Like it cuts through a lot of confusion. And now I guess to really wield that power effectively, we probably need to build up a kind of mental toolkit, a specialized vocabulary that helps us categorize all these different costs accurately.
Exactly. Think of it like getting a more precise compass for your decision-making journey. Once you can accurately label a cost, you're halfway there. So let's break down the key terms you'll bump into and really understand why they matter for marginal analysis, especially as we move into some practical examples soon.
Okay, let's build that vocabulary.
All right, first, let's talk about the costs that are, well, usually pretty straightforwardly relevant. We have direct costs. These are costs you can specifically identify with or trace directly to a particular cost object like a product, a project, a department. So if you're making, say, a custom piece of furniture, the specific planks of wood used for that piece, the fabric for that chair's upholstery, or the wages paid to the specific craftsperson assembling that piece, those are direct costs. They link right to the thing you're evaluating.
Makes sense. They touch the thing directly.
Right. And they usually change when you change what you're making or how much of it. So generally relevant. Closely related are prime costs. This is simply the sum of your direct material costs and your direct labor costs. Think of them as the fundamental frontline hands-on costs of actually producing a good or service.
Okay, just adding the two main direct ones together.
Exactly. And because they're the core inputs, they're almost always relevant in marginal analysis because they directly fluctuate with changes in production. Very hard for these not to be relevant most of the time. Then there are discretionary costs. Now, these are a bit different. They aren't tied directly to manufacturing volume like direct costs are. Instead, they usually come from periodic budgeting decisions, often made annually by management. They're about areas not directly related to producing one specific unit. Things like marketing campaigns, research and development budgets, or an example from our sources, the costs to maintain the landscaping at corporate headquarters. Management decides to spend this money.
Ah, so they're discretionary because management has the discretion to spend them or not.
Precisely. Because management can choose to incur them or adjust their level or even cut them entirely, these costs are generally relevant to decisions about those specific discretionary activities. If you're deciding whether to cut the R&D budget, well, the R&D costs are obviously relevant to that choice.
Got it. Okay.
Now, here's a really pivotal category, one that gets right to the heart of this what changes idea: incremental costs. You might also hear these called marginal costs or differential costs, or sometimes even out-of-pocket costs. They all mean basically the same thing. These are the additional costs you incur when you decide to produce an additional amount of something over your current output or when you take on a completely new project.
So the cost of doing just one more thing.
Exactly. If you decide to make just one more widget or accept that special order for 1,000 units, what are the extra costs associated only with that increase? Incremental costs are always relevant because they are the direct, immediate consequence of your decision to do more. And crucially, this is really important, they include all the variable costs associated with that additional unit or project and any fixed costs that become avoidable or change as a direct result of that decision.
Okay, so it's variable costs plus any fixed costs that go away if you don't do the extra thing.
That's a great way to put it, avoidable fixed costs. That distinction is absolutely vital for getting the analysis right. We'll see that in the examples. And building on that, we have opportunity costs. This is often the trickiest one for people to really internalize, I find.
Yeah, I've heard this term, but it always feels a bit abstract.
It can feel abstract because it often doesn't involve writing a check, but it's incredibly real. An opportunity cost is the cost of foregoing the next best alternative when you make a decision. It's essentially what you lose out on by choosing path A instead of path B. and opportunity costs are always relevant.
Can you give an example?
Sure. Let's say you decide to take on a big special order that uses up all your available machine time for the next month. But doing that means you have to turn down another, smaller, but maybe highly profitable regular customer order you could have fulfilled with that same machine time. The profit you would have made from that turned down order, that's a very real opportunity cost of taking the special order.
Ah, okay. So it's the profit I didn't get because I chose something else.
Exactly. Or another example from the sources. If you use a specific area of your plant space to make product X, the revenue you could have earned from using that same space to make product Y, instead, is an opportunity cost of choosing product X. It's the value of the road not taken, and ignoring it can lead to really bad decisions, even if it doesn't show up as a line item expense on a traditional income statement.
Okay, that makes more sense. It's the hidden cost of choosing. So we've covered a lot of things that are relevant. What about the flip side? What are the things we should be actively pushing aside, ignoring, even if they feel big and important?
That's just as critical.
Yeah.
On the other side of the coin, we have irrelevant costs. These are, well, by definition, costs that do not differ among the alternatives you're considering. Because they don't change whether you pick option A or option B, they simply should be ignored in a marginal cost analysis. They offer zero help in making a better choice. They just clutter the picture. And the most common and often most emotionally difficult type of irrelevant cost is a sunk cost.
Ah, sunk costs. Heard of those too. Money down the drain, right?
Pretty much. Sunk costs are costs that were incurred in the past and, crucially, cannot be recovered as a result of any decision you make now. They are unavoidable in the sense that the money is already spent. It's gone. Therefore, sunk costs are not relevant costs for future decisions. Let's use a classic example that trips up so many businesses. Imagine our electromag corporation is thinking about replacing an old piece of equipment with a brand new, more efficient model. Maybe they originally paid, say, $100,000 for that old machine 5 years ago. That $100,000 they paid, that's a sunk cost.
Okay.
It's already gone. You can't get it back by deciding whether or not to buy the new machine today. The decision to replace the equipment should only be based on the future costs and benefits of the new machine compared to the future costs and benefits of keeping the old one. What you already spent on the old one is history. It has absolutely no bearing on the current decision.
That's hard though, isn't it? Feels like you're wasting that initial $100,000 if you scrap the old machine.
It feels exactly like that. That's the psychological trap. But financially, that money is truly gone regardless of your current choice. Letting it influence your new decision, it's just throwing good money after bad, potentially. And here's that other aha moment we touched on earlier, the one that often surprises people. Even variable costs can be irrelevant sometimes.
Right, the electricity example.
Exactly. Sticking with Electromag and their equipment decision. Let's say under either alternative, keep the old machine or replace it with the new one, the anticipated cost of electricity needed to run the machinery stays exactly the same. Maybe both machines use similar power, or maybe the production volume isn't changing. Even though electricity is typically a variable cost, in this specific decision between keeping or replacing, it's not relevant because it doesn't change regardless of which alternative they pick.
Wow, okay.
It just hammers home why you can't use shortcuts like variable is relevant, fixed is irrelevant. You always have to ask, does this specific cost actually change between these specific options I'm considering right now?
That's a much better question to ask.
It is. Now, a couple more useful distinctions. We also categorize costs as controllable costs or uncontrollable costs. Controllable costs are pretty much what they sound like. They're costs that can be authorized or significantly influenced by the specific business unit manager or the decision maker looking at the options. The ability to control a cost is what makes it potentially relevant. So if a manager can change it, it's controllable, and therefore it's relevant if it will actually change as a result of selecting one alternative over another.
Okay, makes sense. If you can control it, you should consider it if it changes.
Exactly.
Yeah.
Uncontrollable costs, on the other hand, are costs that were authorized at a different level in the organization, usually higher up than the manager making the current decision. These are not relevant costs to that manager's specific decision because they simply cannot be changed by that manager. For instance, a manufacturing department manager probably has direct control over the cost of materials and supplies used in their department. Those are controllable costs for them.
Right.
But that same manager likely has zero control over the amount of fixed asset depreciation that gets allocated to their department from, say, the main factory building. That allocation was probably determined by corporate accounting or senior management based on square footage or something. So that depreciation cost is uncontrollable for the department manager and therefore irrelevant to their day-to-day operational decisions about production levels or whether to accept a small special order.
Got it. Depends on who's making the decision and what they can actually change.
Precisely. And one final pair, which is closely related to relevance. Avoidable costs and revenues versus unavoidable costs. Avoidable costs and revenues are those costs and revenues that result directly from choosing one course of action instead of another. By not selecting a particular action, the firm avoids those specific costs and revenues. They are inherently relevant to the decision because they represent a direct financial consequence of your choice.
So if I don't do X, I avoid cost Y. Cost Y is avoidable.
Exactly. Conversely, unavoidable costs are costs that remain exactly the same, regardless of which course of action you choose. They will continue no matter what you decide to do in this instance. These costs have absolutely no effect on the decision at hand, so they're not relevant to future choices. They're just part of the baseline operational landscape, a fixed expense that won't shift based on this particular decision.
Okay, that is a seriously powerful and precise vocabulary for dissecting costs. Now we've got our toolkit sort of fully stocked, and we really understand this critical difference between what matters, what changes, and what's just noise. Let's actually dive into some real-world business dilemmas. Let's put this into practice, and we'll start with a total classic, special order decisions. So picture this. You're running a manufacturing plant, maybe making widgets, whatever, and you get a phone call or maybe an email, totally out of the blue from a new potential customer. They're offering a one-time deal, maybe for a large quantity, but at a specially negotiated, probably lower price than you normally charge your regular customers. It's outside your usual sales channels. The immediate question hits you. Do you accept this deal or do you turn it down? It sounds simple on the surface, but as we've just spent all this time learning, you definitely can't just look at your, full average cost per unit and compare it to their offer price, right?
Absolutely not. That's the trap. Special order decisions are all about whether to accept or reject a unique, usually short-term, order that comes in at a non-standard price. The core of making this decision correctly involves comparing the price they're offering you for the special order against the relevant costs, only the relevant costs of actually fulfilling that specific order. And, as we'll discuss, it's also crucial to analyze some strategic issues that go beyond just the immediate numbers. Now, these decisions often operate under the initial assumption that you have excess production capacity, meaning you're not already running your factory flat out 24/7.
Okay, so you have some slack in the system.
Exactly. If that's the case, your existing fixed cost things like your factory rent, the depreciation on the machines you already own, maybe the salaries of your permanent staff, they're generally not relevant to this specific special order decision. Why? Because accepting this one-time order isn't going to change those total fixed costs. You're already paying for the factory and the equipment whether you take this order or not, so producing a few more units in your spare time doesn't add to those specific overheads.
Right, the factory rent doesn't suddenly go up because you make 1,000 extra widgets this month.
Precisely. So let's look at this capacity issue in a bit more detail because it really does fundamentally change how you do the calculation. First scenario, presumed excess capacity. This is often the ideal situation for considering a special order. If your company has unused production capacity, maybe machines sitting idle some of the time, underutilized factory floor space, or maybe workers who aren't fully busy, then accepting a special order doesn't force you to incur new fixed costs. And critically, it also doesn't force you to give up other potentially more profitable regular sales. In this situation, the analysis is actually quite straightforward. You just compare the incremental costs, the cost of producing just that additional order, to the incremental revenue you'll get from it. And the decision rule is pretty simple. The special order should be accepted if the selling price per unit the customer is offering is greater than the variable cost per unit required to produce it. You're basically just trying to make sure the order covers its own direct out-of-pocket costs and maybe contributes a little extra to overhead or profit.
Okay, so if price is higher than variable cost and you have the spare time space, it's probably a yes.
Generally, yes, from a purely short-term financial perspective. Let's make this really concrete with an example. Example 1. Cater Company excess capacity. Let's say Cater Company makes industrial components. Their main product, KB96, normally sells for $150 per unit in the regular market channels. Their internal cost accountants have figured out the detailed per unit costs based on their typical production levels. These are direct materials, $20, direct labor, $15, variable manufacturing overhead, $12, fixed manufacturing overhead, $30, shipping and handling costs $3, let's assume this is variable, and fixed selling costs $10. Now, if you add all those up, $20 plus $50 plus $12 plus $30 plus $3 plus $10. Their total full cost per unit looks like $90.
Okay, $90 full cost, $150 selling price normally.
Right. Now, Cater has just received a special one-time order request for 1,000 units of this KB96 product. This customer is offering a price that's definitely below the usual $150. The critical question is, assuming Cater does have excess capacity, plenty of idle machine time, etc., what's the absolute minimum acceptable price per unit for this special order that they should even consider? Below what price should they just say, no thanks?
Okay, how do we figure that out using marginal analysis?
First, we ruthlessly identify the irrelevant cost for this specific decision. Since Cater has excess capacity, the fixed manufacturing overhead of $30 per unit and the fixed selling cost of $10 per unit are not relevant.
Because they won't change.
Exactly. Those total fixed costs, the factory rent, the depreciation on existing machines, the salaries of the fixed sales staff, they won't change one bit just because Cater decides to accept this one-time 1,000-unit order. They're already being incurred regardless. So for this decision, we ignore the $30 and the $10.
Okay, scratch those off the list.
Right. Instead, we focus only on the relevant costs. These are the incremental costs, the ones directly tied to producing these specific additional 1,000 units. These include direct materials, $20, direct labor, $15, variable manufacturing overhead, $12, and the shipping and handling, $3, which we're assuming is variable with the order. These are all variable costs in this case, and they represent the true incremental per unit production costs, the costs that Cater would only incur if they decide to take this specific order.
So we just add those up.
Yep. Let's add those relevant costs. $20 plus $15 plus $12 plus $3. That equals $50. This $50 represents the incremental per unit cost to Cater for this special order. Therefore, the conclusion is Cater should accept this special order only if the selling price per unit offered by the customer is greater than $50.
Wow. Okay, so even if they offer, say, $60, which is way below the normal $150 price and way below the $90 full cost, it could still be profitable?
Absolutely. If they offer $60, each unit is contributing $10, $60 price, $50 relevant cost, towards covering those fixed overheads that Cater has to pay anyway. That's $10,000 extra contribution margin, 1,000 units they wouldn't otherwise have. See how we completely ignored the fixed costs that don't actually change? That's the core power here. It stops you from automatically rejecting potentially profitable business just because the offer price is below your calculated full cost per unit. It allows you to capture extra revenue when you have the spare capacity.
That makes a huge difference. But what happens if they don't have that spare capacity? What if the factory is already running full tilt?
Now that brings us to the second, more complex but actually very common scenario, presumed full capacity. If your company is already operating at its maximum production limits, maybe all the machines are running 24/7, or you physically can't fit more production into the schedule, then accepting a special order means you inevitably have to give up something else. You can't just magically produce more out of thin air.
Right, you have to make a trade-off.
Exactly. And this, something else that you give up, represents, as we defined earlier, an opportunity cost. And this opportunity cost absolutely must be included in your analysis when you're at full capacity. The production that you have to forfeit in order to produce the special order is the next best alternative use of your already fully utilized facility. The opportunity cost, specifically in this context, is the contribution margin that you would have earned from the product or order you had to give up if you hadn't accepted the special order. It's the profit you sacrifice.
Okay, so the cost isn't just the materials and labor, it's also the profit I didn't make elsewhere.
Precisely. Let's use example 2. Cater company, no excess capacity. Assume the exact same underlying costs as before for product KB96, $20 DM, $15 VL, $12 VMOH, $3 shipping. Cater has again received that special one-time order offer for 1,000 units of KB96. But this time, Cater's operating at full capacity. This is the crucial difference. They have no idle time, no spare machines. And to make it concrete, let's assume that the next best alternative use of that already maxed out capacity, the 1,000 units worth of production time they'd need for the special order, would have been to produce another product. Let's call it LB64, and producing LB64 normally generates a contribution margin of $10,000 for that amount of production effort.
Okay, so if they take the special order, they lose out on $10,000 profit from LB64.
Exactly. So the question now is, what's the minimum acceptable price for this special order, given that Cater is at full capacity and faces this opportunity cost?
How does that $10,000 loss factor in?
Well, first, we still have the incremental variable costs of $50 per unit for making KB96, just like we calculated in example 1. Those direct costs don't change based on capacity level. That's still $50 per unit out of pocket. But now, because Cater's at full capacity, taking this 1,000 unit special order means giving up the chance to produce LB64, which would have generated that $10,000 contribution margin. To factor this lost contribution margin into the per unit relevant cost of the special order, we treat it as an opportunity cost. We need to spread that total loss contribution over the units in the special order. So we divide the total loss contribution margin by the number of units in the special order. $10,000 loss contribution, 1,000 units in the special order equals $10 per unit. This $10 represents the per unit opportunity cost of taking the special order. It's the profit they sacrifice on LB64 for every unit of KB96 they make instead for this special deal.
Okay, so the opportunity cost is $10 per unit.
Right. So now we add this opportunity cost to our direct variable cost. $50 variable cost plus $10 opportunity cost equals $60. In this scenario, with no excess capacity, Cater should accept the special order only if the selling price per unit offered is greater than $60.
Wow, so the minimum acceptable price just jumped from $50 to $60 because they were already busy.
Exactly. It dramatically changes the required price point. This really shows why you can't just look at the out-of-pocket variable costs when you're already maxed out. You absolutely have to consider what you're giving up because that lost opportunity is a very real economic cost of your decision, even if it's not a direct cash payment. Ignoring it means you might accept an order that actually makes the company worse off overall.
That's a critical distinction, but are there other things to think about besides just hitting that minimum price, like strategic stuff?
Well, absolutely. Beyond just the pure numbers, special order decisions require careful consideration of several vital strategic factors. These can sometimes outweigh a small positive contribution margin. For instance, think about the effect on your regular business. How will accepting a lower price special order impact your regular price sales and your overall brand image? Could it cannibalize your existing sales?
Yeah, like if your regular customers find out you gave someone else a huge discount.
Exactly. Will your long-term loyal customers start demanding the same low price? That could erode your margins across the board. That's a huge risk. You also need to think about the future potential with this new customer. Is this special order just a one-off deal, or could it be a foot in the door, an opportunity to build a profitable long-term relationship? Sometimes taking a small hit now can pay off later. Then there are operational considerations. Is it possible that taking this order, even if you think you have capacity, might actually push you over your limits or strain your resources unexpectedly? Or maybe the order itself is unusually complex. Perhaps it requires special tooling, unique quality checks, or difficult logistics, making it much harder or more costly to fulfill than you initially calculated based on your standard product costs.
Right, hidden complexities.
Yep. And don't forget things like the impact of income taxes, which can affect the net benefit, or even the effect on your physical assets will taking on this large, maybe rushed order cause extra wear and tear on your machinery. Will it burn out your equipment faster or disrupt your carefully planned maintenance schedule, leading to unexpected downtime and costs later on?
So many factors.
It's true. These factors, while maybe not neatly fitting into the immediate cost calculation, can significantly impact the long-term health and profitability of your business. A truly smart manager weighs these strategic considerations right alongside the marginal cost analysis before making the final call.
Okay, that special order scenario, especially the capacity part, really hammered home that what changes principle. And actually, that same idea, really drilling down into the costs that actually change, seems absolutely critical in another huge dilemma companies face all the time. That's the question of whether to produce something yourself, in-house, or just buy it from an external supplier. It's the classic insourcing versus outsourcing question, isn't it? And the stakes there can be incredibly high, affecting jobs, quality, control, everything.
You're spot on. It's a fundamental strategic decision.
Yeah.
And the goal for managers here, at least at first glance, seems straightforward. Just select the lowest cost alternative, right?
Yeah.
Make it if that's cheaper, buy it if that's cheaper. But again, just like with special orders, it's definitely not as simple as just looking at the headline price quoted by an outside vendor and comparing it to your internal full cost. It requires that same rigorous identification of the relevant costs, both for making it internally and for buying it externally.
And I bet capacity plays a big role here, too.
It plays a huge role, yes. Let's break that down. If you have excess capacity, meaning you've got idle resources like unused machines, maybe some extra factory space, or a workforce that isn't working at full stretch, then the cost of making the product internally is essentially the sum of all the costs that you will avoid or save if you decide not to make the product and buy it instead.
So the costs that disappear if you choose buy.
Precisely. These are typically the variable costs, materials, direct labor, variable overhead, plus any avoidable fixed costs associated with that specific production activity. This total avoided cost then represents the maximum outside purchase price the company should even consider paying. If the external supplier wants to charge you more than what you'd save by not making it yourself, then it's clearly cheaper to just keep making it in-house, especially since your unavoidable fixed costs, like the factory rent, are already being covered anyway.
Okay, that makes sense for excess capacity. What if you're already busy, like in the second special order example? No excess capacity.
Right. If there's no excess capacity, meaning your company's already operating at full tilt, the situation changes significantly, just like before. In this scenario, the relevant cost of making the product internally includes not only the costs you would avoid if you didn't make it, the variable costs and avoidable fixed costs, but also the opportunity costs associated with using that capacity yourself.
Ah, the opportunity cost again. What you're giving up.
Exactly. That opportunity cost is, again, the contribution margin you'd lose by giving up the next best alternative use of your fully utilized resources. For example, if making a specific component in-house prevents you from producing a different, highly profitable product that could have used that same machine or those same workers, the lost profit from that other high-margin product becomes a critical component of the true cost of making the component yourself.
You have to factor in the profit you could have made elsewhere.
You absolutely must. Let's walk through a concrete example to see how this works, especially with those tricky fixed costs. Example 3. Offset manufacturing make versus buy. Offset manufacturing currently produces 20,000 units of a specific part, let's call it part NOM 125, internally each year. They're now trying to decide, should they continue to make this part, or should they start buying it from an outside supplier who's made them an offer? Their current internal production costs for these 20,000 parts are broken down like this. Direct materials, total $10,000, which is 50 cents per unit. Direct labor, total $40,000, $2 per unit. Variable manufacturing overhead, total $20,000, $1 per unit. Fixed factory overhead, total $40,000, $2 per unit. If you sum all those up, 10K plus 40K plus 20K plus 40K, your total internal cost appears to be $110,000, or $5.50 per unit, plus $2 plus $1 plus $2.
Okay, $5.50 per unit total cost to make it.
Right. Now, an outside manufacturer has come along and offered to sell offset manufacturing the exact same part, meeting all quality specs, for just $5 per unit.
Ah, so $5 to buy versus $5.50 to make. Looks like they should buy it, right? Cheaper on the surface.
That's the surface view, and it's often wrong.
Mm-hmm.
We need more information. First, let's assume offset currently has excess capacity. They're not maxed out. They have the space and time to keep making this part without giving up anything else. So, no opportunity cost in this specific scenario. But here is the absolutely crucial piece of information that makes all the difference. The source tells us that out of the $40,000 total fixed factory overhead currently allocated to this part, only $10,000 represents a factory floor supervisor's salary, and the supervisor would be laid off, or their cost eliminated, if Offset stops making the part and buys it instead. The remaining $30,000 in fixed factory overhead, things like general factory rent, depreciation on shared machinery used for many parts, property taxes on the building, these costs will continue regardless of whether Offset makes this specific part No. 125 or not.
Mm-hmm.
They are unavoidable.
Okay, that's the key detail. Only $10 of the fixed cost actually disappears if they buy.
Exactly. That's the avoidable fixed cost.
Mm.
So the question for offset manufacturing is, given this breakdown, should they make or buy the part?
Let's walk through the marginal analysis.
Okay, let's set up a rigorous make versus buy comparison, focusing only on the relevant costs for each alternative over the full 20,000 units. First, let's analyze the make alternative, considering only the costs Offset would incur if they continue to produce it and only the costs that would change if they stopped. Direct materials, total $10,000. Is this relevant? Yes, because if Offset stops making the part, they won't incur these material costs. It's avoidable. So $10,000 is relevant. Direct labor, total $40,000. Relevant? Yes, for the same reason. These labor costs would be avoided if they stop production. $40,000 is relevant. Variable manufacturing overhead, total $20,000.
Right.
Relevant? Yes. Again, these costs would be avoided if production ceases. $20,000 is relevant. Fixed factory overhead. Now, this is where the careful distinction is critical. The total allocated fixed overhead was $40,000. But we know only the $10,000 supervisor's salary will actually be eliminated if Offset buys the part. This $10,000 is therefore an avoidable fixed cost, making it relevant to this decision.
And the other $30,000?
The remaining $30,000, $40,000 total, $10,000 avoidable, is unavoidable. It will continue even if they stop making this specific part. Therefore, that $30,000 is irrelevant to this decision. We ignore it.
Okay, so only the $10 fixed cost is relevant for the make side.
Correct. So the total relevant costs for the make alternative are $10,000 DM plus $40,000 plus $20,000 VMOH plus $10,000 avoidable FFOH. That sums up to $80,000. On a per unit basis, that's $80,000 divided by 20,000 units, which equals $4 per unit relevant cost to make.
$4 per unit relevant cost to make. Got it.
Now, what about the buy side?
Okay, now for the buy alternative. What are the relevant costs if they choose to purchase from the outside supplier? The only relevant cost here is the actual purchase price they have to pay the outside manufacturer. The offer was $5 per unit. For 20,000 units, the total relevant cost for buy would be $5 per unit multiplied by 20,000 unit, which totals $100,000. On a per unit basis, that's simply $5.
Okay, so now we compare. Relevant cost to make is $80,000 total, or $4 per unit. Relevant cost to buy is $100,000 total, or $5 per unit. Exactly. So comparing the total relevant costs, make is $80,000 and buy is $100,000. The difference is $100,000 buy cost minus $80,000 make cost equals $20,000. This means it's actually $20,000 cheaper overall for Offset to continue to make the part internally when only the costs that actually change are considered.
Wow, so the initial comparison of $5.50 to make versus $5 to buy was completely misleading.
Completely misleading. Based on that superficial comparison, they would have wrongly decided to buy the part and would have ended up $20,000 worse off each year. The conclusion. Offset will choose to make the part because it is the lowest cost alternative when only relevant costs are analyzed.
This example just perfectly illustrates why simply looking at the total cost per unit calculated by traditional absorption costing can be so dangerous for decision making. You absolutely have to dig deeper and break down those fixed costs into their avoidable and unavoidable components.
That's the absolute core insight here. Don't let a higher average cost on paper, inflated by allocated fixed costs that won't actually disappear, trick you into making a financially worse decision. You have to isolate the true incremental impact.
Makes total sense. Are there strategic factors here too, like with special orders?
Oh, definitely. And they can be even more critical in make or buy decisions, given the long-term implications. You absolutely need to consider strategic factors beyond the immediate cost comparison. Think about quality control. Can the outside supplier consistently meet your required quality standards? Is the quality of the purchased product likely to be better, worse, or the same as what you manufacture in-house?
That's huge.
Huge. And reliability. Is the outside supplier dependable? Will they deliver on time every time? What happens if their production line goes down? How much control do you lose? Also, what's the value of any service contracts or warranties offered by the supplier? And how does that compare to your internal maintenance capabilities and costs? There are also significant risks often associated with outsourcing or buying critical components outside the organization. Things like potential inflexibility. What if your own product design changes rapidly? Can the supplier keep up? There's often a loss of direct control over the manufacturing process, which might be important for innovation or quick adjustments. And there could be issues around confidentiality, especially if the component involves proprietary technology or is crucial to your core intellectual property. Do you want an external party having access to that?
Yep.
And finally, you must always circle back to the most efficient use of your entity's overall resources. If you do free up internal capacity by buying this part, what is the absolute best alternative use for that freed up space, those machines or those employees? Is there an opportunity to launch a different, perhaps higher margin product that would better utilize those internal resources and potentially be even more profitable for the company than the savings from buying this one part? That opportunity cost calculation comes back into play.
Okay, that make or buy decision really drives home how deeply you have to investigate those fixed costs and consider the strategic angle. Let's move on. Next up, another really common decision that many manufacturers and even other types of businesses face after a product has already gone through its initial production steps. Let's use your earlier analogy. Imagine you're running that boutique soap company. You've mixed the fats and lye, gone through the basic process, and now you've got this big batch of plain, basic, unscented soap bars. They're perfectly good, ready to be packaged and sold just as they are. You could definitely sell them right now at the split-off point. But then you look at that vat of basic soap and you start thinking, what if we added some expensive lavender essential oil? Or maybe some exotic rose absolute and fancy packaging? Could we put in more effort, spend more money, process it further to turn it into something even more valuable, hoping to fetch a much higher price in the luxury market? This is that classic sell now or process further dilemma, isn't it? And it feels like it should be all about maximizing the profit you can squeeze out of those initial raw materials you already committed to.
That's a fantastic setup because it perfectly captures the essence of this decision, which is common in so many industries. Think refining crude oil into different fuels, processing timber into various wood products, or, yes, turning basic soap into fancy soap. The decision on whether to sell a product at a certain intermediate stage, the split-off point, or to invest more resources to process it further, is based purely on the profitability analysis after that split-off point. And understanding this requires getting clear on two critical cost categories that are unique to this type of situation: joint costs and separable costs.
Okay, joint costs and separate costs, what are they?
Joint costs are all the costs incurred in a single production process, up to the point where multiple distinct products emerge. That point is called the split-off point. Think of a meat processor again. All the costs of acquiring and initially processing the pig up until the point where you can clearly identify separate products like ham, bacon, pork chops. Those are joint costs. Or the cost of drilling for crude oil before it's refined into gasoline, kerosene, etc. The absolutely crucial thing about joint costs is that they cannot be logically traced or allocated to the individual end products until after that split-off point. And because these joint costs have already been incurred to get you to the split-off point, regardless of what you decide to do next with the individual products, sell the bacon now or cure it further, joint costs are considered sunk costs for the purpose of this specific sell or process further decision.
Ah, sunk costs again. So the cost of the pig or the cost of drilling the oil well irrelevant to whether I should make fancy bacon or premium gasoline.
Exactly. As far as that specific decision is concerned, those costs are irrelevant. They've already been spent to get you the basic products at the split-off point. They won't change based on whether you decide to process the ham further or not. There are water under the bridge for this decision.
Okay, that's a big one to ignore. What about separable costs?
Its separable costs, in contrast, are all the costs incurred after the split-off point. These are the costs that can be directly traced to the individual products because they happen after the products have become distinct. Examples would be the cost of the special packaging required only for the smoked ham, the unique spices and curing process used only for the fancy bacon, or, in your example, the specific cost of the lavender perfume and purple dye added only to the lavender soap. These costs are relevant because you only incur them if you choose to process that specific product further down that particular path. If you decide not to make lavender soap, you simply don't incur the cost of the lavender scent or the purple packaging. They are directly tied to the process further decision.
Okay, so joint costs are sunk and irrelevant. Separable costs happen after split off and are relevant. How do we use that to decide?
The decision itself boils down to a very straightforward comparison. You compare the incremental revenue you'll gain from processing further against the incremental cost, which are the separable costs, you'll incur after the split-off point for that further processing. It's all about the net financial impact of that additional step.
So does the extra money I get cover the extra money I spend?
Precisely. Here are the clear decision rules. 1. If the incremental revenue you expect to get from further processing exceeds the incremental separable cost you have to incur for that processing, then yes, the organization should process further. It's a financially positive step. You're adding more value than the cost of creating that extra value. 2. However, if the incremental separable cost of processing further exceeds the incremental revenue you'd gain from it, then the organization should stop right there and sell the product at the split-off point. It's simply not economically worthwhile to put in the extra effort and expense. You'd be losing money on that extra step.
Okay, that seems logical. Compare the extra gain versus the extra pain.
Exactly. Let's look at an example to make this really concrete. Example 4. Jackson Inc. Soap division. Let's say Jackson Inc. processes raw fats and line to beauty products. Their soap division takes these raw materials and processes them at a joint cost of $200 per batch. This initial process yields 2,000 bars of basic, plain, unscented soap. At this split-off point, right after the basic soap is made, they have the option to sell this basic soap immediately for $2.50 per bar.
Okay, $200 joint cost gets them 2,000 bars they can sell for 50 cents each right away.
Correct. Alternatively, they have options for further processing. They can take this basic soap and add various perfumes and attractive packaging to create fine soaps aimed at the high-end retail market. They're considering two options. Option 1, lavender-scented soap. Creating this version would incur an additional severable cost of $1.20 per bar for the lavender scent purple dye fancy box. If they make this, they believe they can sell the lavender soap for $1.30 per bar. Option 2, rose-scented soap. Creating this premium version would incur an additional separable cost of $1.75 per bar for the expensive rose oil, pink coloring, even fancier packaging. They estimate they could sell this rose-scented soap for $3 per bar.
Okay, two different upgrade paths with different costs and different selling prices.
Exactly. The question for Jackson Inc.'s soap division is, which path should they take? Should they produce the lavender soap? Should they produce the rose-scented soap? Or should they just stick to selling the basic soap at the split-off point for $2.50? Maybe they should do both, or neither.
How do we figure this out? What's
Yeah.
the first step?
The absolute crucial first step is to recognize that the initial $200 batch the cost to make the basic soap in the first place is a joint cost. It was incurred before the split-off point. Therefore, it is a sunk cost and completely irrelevant to this specific decision about whether to process further into lavender or rose scents.
Right.
Ignore the $200. Ignore the $200, and we only care about the costs and revenues that happen after the basic soap exists and could be sold for $1.50 per. So let's analyze the lavender soap option first. What is the incremental cost, the separable cost, to produce the lavender soap beyond the basic soap stage? The example tells us it's $1.20 per bar. What is the incremental revenue gained by producing lavender soap instead of just selling the basic soap? It's the difference between the lavender selling price and the basic soap selling price.
Yeah.
So $1.30 lavender price minus 50 cents basic soap price equals $0.80 per bar. This is the extra revenue you get specifically for making it lavender.
Cost $1.20 extra, brings in 80 cents extra.
Right, now we compare. The incremental cost, $1.20, is greater than the incremental revenue. Conclusion, Jackson Inc. should not produce the lavender soap. It simply costs more, $1.20, to take that extra step than the additional revenue it brings in. They would actually be losing $1.40 per bar, $1 to $20.80, by choosing to make the lavender soap compared to just selling the basic soap.
Ouch. Okay, so lavender is a no-go. What about the rose version?
Now let's analyze the rose-scented soap option using the same logic. What is the incremental cost, separable cost, to produce the rose-scented soap? The example states it's $1.75 per bar. What is the incremental revenue gain from producing rose-scented soap instead of basic soap? We take the rose selling price, $3, minus the basic soap selling price, which equals $2.50 per bar.
Cost $1.75 extra, brings in $2.50 extra.
Correct. Comparing these, the incremental revenue, $2.50, is greater than the incremental cost, $1.75. Conclusion, Jackson Inc. should produce the rose-scented soap. This option clearly adds significant value. For every bar they process further into rose soap, they gain an extra $1.75 in profit. $2.50 incremental revenue minus $1.75 incremental cost, compared to just selling the basic soap. The additional revenue significantly outweighs the additional cost for this option.
So the answer is sell the basic soap or process it further into rose soap, but definitely don't bother with the lavender.
Precisely. This example really drives home the point we made earlier. Just because you can add value or further process a product doesn't automatically mean you should. It always comes down to whether that specific additional revenue you gain from the extra step outweighs the specific additional cost you incur from that point forward. Past costs, those joint costs like the initial $200, they're history. They don't matter for this future-oriented decision. Only the future incremental impacts do.
That soap example makes so much sense. It really isolates the profitability of that extra step. Okay, for our final scenario, let's tackle what you mentioned earlier as one of the toughest and often most emotionally charged decisions a business can face. That's the decision whether to keep or drop an entire product line, or maybe even a whole business segment or division. This can feel really, really painful, can it? Especially if a segment has been around for a long time. Maybe it carries the company founder's name, or it employs a lot of people who've been with the company for years. The human element is huge. But setting aside the very real emotional and HR aspects for a moment, from a purely financial perspective, marginal analysis can provide a much clearer, more objective view, even when our gut instincts or historical attachments might be telling us otherwise.
You're absolutely right, host speaker. This decision is often incredibly fraught with emotion, history, and internal politics. But if we're looking strictly at the financial health and long-term viability of the overall business, then yes, focusing on the relevant costs and revenues is paramount. It provides a crucial analytical anchor. The absolutely pivotal step here, the thing that makes or breaks the analysis, is to take all the fixed costs that are currently associated with or allocated to that segment you're thinking about dropping and rigorously, honestly classify them as either avoidable or unavoidable.
Avoidable meaning they will disappear if the segment is discontinued.
Exactly. Those are relevant. And unavoidable meaning they are irrelevant because they will continue to be incurred by the company even if the segment is dropped. Maybe it's shared corporate overhead or rent on a long-term lease for a facility that has multiple segments. This distinction, which we've really been emphasizing throughout our discussion, makes all the difference in these very high-stakes keep-or-drop decisions.
Okay, so job one is sorting the fixed costs into will go away versus will stick around. Then what?
Then the decision factors boil down to a direct comparison. A firm needs to compare two key numbers. One, the total fixed costs that can be avoided if the segment is dropped, essentially the specific costs of running just that segment that would truly vanish. Two, against the total contribution margin that will be lost if the segment is dropped. Remember, contribution margin is the segment's sales revenue minus its variable costs. It represents how much that segment was contributing towards covering the entity's overall fixed cost and generating profit.
Okay, compare the costs saved versus the contribution lost.
Precisely. And that comparison leads to two clear decision rules, based purely on maximizing overall company profitability. One, you should keep the segment if the lost contribution margin exceeds the avoided fixed costs. What does this mean? It means that even if the segment might be showing an accounting loss on paper because a lot of unavoidable fixed costs were allocated to it, it's still generating enough contribution margin from its sales to cover more than the fixed costs you'd actually save by getting rid of it. Dropping it would actually make the company worse off overall because you'd lose more contribution than you save in avoidable costs.
Interesting. So a segment showing a loss might still be worth keeping.
Absolutely. That's a hugely important insight from this type of analysis, too. Conversely, you should drop the segment if the lost contribution margin is less than the avoided fixed costs. In this situation, the savings you achieve by eliminating the fixed costs that can actually be avoided are greater than the contribution to overhead and profit that you lose from the segment sales. Dropping it would therefore improve overall company profitability because you're shedding more in relevant costs than you're losing in relevant revenue contribution.
Okay, let's see this in action. I imagine an example would make this really clear.
Definitely. Let's use example 5. Chowderhead Industries' fixed costs are unavoidable. Imagine Chowderhead Industries has 3 distinct product lines: clam chowder, conch chowder, and corn chowder. Their latest internal report, which uses variable costing principles, shows the following results for the period. Clam chowder: sales $125K, VAR cost $90K, CM $35K, fixed cost $20K, op income $15, profitable. Conch chowder: sales $75K, VAR cost $60K, CM $50K, fixed cost $20K, op income $5,000, loss. Corn chowder: sales $50K, VAR cost $25K, CM $25K, fixed cost $20K, op income $5, profitable. If you add up the operating income for all three, $15K, $5K, plus $5K, the total company operating income is currently $15,000.
Okay, so conch chowder is the obvious problem child here, showing a $5,000 loss. The instinct is probably to drop it, right?
That's the immediate instinct, looking at that bottom line for conch. But wait, here's the absolutely crucial fact for this version of the example. Management has determined that the $20,000 in fixed costs currently allocated to the conch chowder line are entirely unavoidable. This means these costs, maybe it's a share of the CEO's salary or the rent on the main chowder factory, will still be incurred by the company. Even if the conch product line is completely eliminated, they won't go away.
Okay, so none of that $20K fixed cost is avoidable. That changes things, doesn't it?
It changes everything. So the question is, should Chowderhead eliminate its conch chowder product line, which appears to be losing money on paper?
Let's figure out the total company profit without conch, using our rules.
Okay. If conch chowder is eliminated, its sales, $75,000, and its variable costs, $60,000, disappear. This means its contribution margin of $15,000 is lost to the company. Total company sales would drop to just clam, $125K, plus corn, $50K, which was $175,000. Total company variable costs would drop to clam, $90K, plus corn, $25K, equals $115,000. The new total contribution margin for the entire company would be $175,000 sales, $115,000 variable costs, equals $60,000.
Okay, contribution margin drops from $75K, 35 plus 15 plus 25, down to $60K. That's the $15 loss from conch. Makes sense. What about fixed costs?
Now, the critical part, total fixed costs. Since conch's $20,000 fixed costs were entirely unavoidable, they will still be incurred by Chowderhead, even without the conch line operated. They have to be covered by the remaining products. So the total fixed costs of the entire company would remain $20,000, clam's fixed, plus $20,000, and conch's unavoidable fixed still there, plus $20,000, corn's fixed equals $60,000.
Whoa. So the total fixed costs don't change at all in this scenario?
Not at all, because none of conch's fixed costs were avoidable. So the new operating income for the entire company would be $60,000, new total contribution margin, $60,000, total unavoidable fixed costs, $0.
Zero profit, down from $15,000 originally.
Exactly. Comparing this $0 outcome to the original total company operating income of $15,000, you see that eliminating the conch chowder line, which looked like a loser, would actually reduce company-wide profits from $15,000 all the way down to zero. Therefore, the conclusion is the conch chowder product line should not be eliminated in this scenario.
That is completely counterintuitive for so many people, I bet. How do you even convince management to keep a product line that's showing a loss on its own report?
It is incredibly counterintuitive if you're just looking at segmented income statements prepared using traditional allocation methods. You have to shift the perspective to marginal analysis and focus on the overall company impact. The way you convince them is by laying out the numbers exactly as we just did. You demonstrate that while CUNC shows an accounting loss due to allocated unavoidable costs, it is still making a positive contribution margin, $15,000 in this case, towards covering the company's total unavoidable fixed costs. Getting rid of it would eliminate that contribution, forcing the other products to bear the full brunt of those unavoidable costs, ultimately lowering total profit. It's about showing the net effect on the entire business, not just looking at one line item in isolation.
Okay, so sometimes the loser is actually helping keep the whole ship afloat. That's a massive insight. But what if the situation was slightly different? What if some of those fixed costs could be avoided?
Great question. Let's flip the script slightly and look at example 6. Chatterhead Industries. Some fixed costs are avoidable. Assume the exact same starting facts as example 5, same sales, variable costs, contribution margins, and total fixed costs initially. Conch still shows that $5,000 parading loss. The total company profit is still $15,000. But now let's change that crucial detail about the fixed costs. Let's assume that $16,000 of the $20,000 fixed costs allocated to conch chowder represent avoidable costs. Maybe it's specific advertising just for conch, or the salary of a product manager who only works on conch. These $16,000 will not be incurred if the product line is eliminated. This leaves only $4,000, $20,000, total fixed $16,000 avoidable as unavoidable fixed costs associated with the conch line. Maybe its share of the factory rent.
Okay, so now dropping conch does save the company $16,000 in actual cash outflow. How does that change the calculation?
Let's recalculate the total company profit if conch is eliminated under these new, slightly different conditions. Again, if conch is dropped, its contribution margin of $15,000 is lost. The total contribution margin for the remaining products, clam plus corn, is still $35,000 plus $25,000 plus $60,000.
Okay, CM loss is still $15. Now the fixed costs.
Right. Now, total unavoidable fixed costs for the company after dropping conch. Clam's fixed costs are still $20,000, assumed unavoidable. Conch's unavoidable fixed costs are now only $4,000 because the $16,000 avoidable portion disappears. Corn's fixed costs are still $20,000, assumed unavoidable. So the total unavoidable fixed costs of the company are $20,000 plus $4,000 plus $20,000 was avoidable.
So the total fixed cost burden does decrease this time from $60K down to $44K.
Exactly, because $16,000 was avoidable. Now let's calculate the new operating income for the company. $60,000. Total contribution margin from remaining products, $44,000. Total unavoidable fixed costs, $16,000.
$16,000 profit. That's higher than the original $15,000.
Precisely. Comparing this new operating income of $16,000 to the original total company operating income of $15,000, we see that eliminating the conch chowder product line now actually improves overall company profitability by $1,000. Therefore, the conclusion in this scenario: the Chowderhead executives should eliminate the conch chowder product line.
And why the different conclusion?
Because the avoidable fixed costs, $16,000 that they save by dropping the line, now exceed the contribution margin that is lost, $15,000. The company saves more in costs that they can actually get rid of than they lose in sales contribution from that line, leading to a net $1,000 gain for the company overall.
It's the exact opposite result from the last example, purely based on whether those fixed costs were avoidable or not.
Exactly. It fundamentally shows that the decision hinges entirely on whether the costs you can actually get rid of are greater than the contribution you lose. That careful, meticulous breakdown of fixed costs into avoidable and unavoidable components is the absolute magic bullet for making the right call in these keep-or-drop situations.
Incredible. But surely there are strategic factors here too. Dropping a whole product line feels like a huge strategic move.
Oh, absolutely huge. Just like with the other decisions, there are critical strategic factors for keep-or-drop decisions that often extend far beyond the immediate financial calculation, and they need to be weighed very carefully. For example, you absolutely must consider the complementary nature of products. Does the segment you're thinking of dropping, even if it's barely profitable on its own, somehow drives significant sales for your other, more profitable products? Is it a loss leader that brings customers in the door who then buy other things?
Right, like selling cheap printers to sell expensive ink cartridges.
Exactly, that kind of relationship. If you drop the chowder, maybe people stop coming to your restaurant altogether, impacting sales of your profitable lobster rolls. You need to understand those interdependencies. Also, think deeply, as you mentioned earlier, about the impact of eliminating a product line or segment on employee morale. Layoffs are incredibly difficult and can significantly affect the productivity, loyalty, and overall culture among the remaining workforce.
Yeah, the human cost.
The human cost is real and has business implications. You also need to assess the future growth potential of each product, regardless of its current individual profitability snapshot. Maybe the struggling conch chowder line is in a market segment that's poised for explosive growth, while your currently profitable clam chowder is in a mature, declining market. Keeping conch might be a strategic investment in the future, even if it hurts a bit now. And finally, always consider the opportunity costs associated with the resources, capacity, capital management, attention you might free up by dropping a segment. What is the absolute best alternative use for that capacity? Could you replace the drop segment with something new, innovative, and potentially much more profitable in the long run? That forward-looking perspective is crucial. Hashtag tag outro.
Wow. Okay, what a deep dive that was through the world of marginal analysis. It really feels like we've seen how just relentlessly focusing on what changes what's truly different between your options can genuinely transform these incredibly complex, sometimes overwhelming business decisions into much clearer, more strategic choices. It's really not about the total cost you see on a report or the total revenue in isolation, is it? It's all about those incremental differences, the relevant pieces of the puzzle, the specific numbers that actually shift based on the decision you make right now. It feels like it forces you to shed all the distractions, all the sunk costs and unavoidable overheads, and just hone in on the things that truly drive profitability for that specific choice.
That's a perfect summary. The key takeaway, the common thread running through all these different scenarios we looked at, whether you're evaluating a one-off special order, making a make-or-buy decision, deciding whether to sell now or process further, or even tackling that really tough call of keeping or dropping an entire segment, the core principle is always the same. You have to rigorously isolate the costs and the revenues that actually differ between your alternatives. Everything else, it's just noise for that decision. If a cost or a revenue number doesn't change based on which path you choose, it's irrelevant. Period. Knowing this, internalizing this, helps you ignore all those distractions and zero in laser-like on the information that truly drives the financial outcome of your choice.
It really clarifies things.
It does. And this, I think, raises a really important question for you, for everyone listening. How might you start to more consciously identify the truly relevant and the truly irrelevant factors in your own decisions? Whether those are big business choices you face at work, or maybe even significant personal financial decisions. What sunk costs, maybe past investments of time, money, or emotion, are you perhaps clinging to that might be holding you back from making a truly optimal decision now? What hidden opportunity costs might you be missing because you're not quite seeing the incremental value of choosing a different path?
That's a really powerful thought to end on. Thinking about the sunk costs and opportunity costs in our own lives. Definitely something to mull over. Thank you so much for guiding us through that, and thank you for diving deep with us today. Until next time, keep asking those insightful questions.